All right, everybody. My name is Signet with the OAC, and I want to discuss today some back testing work that I've been doing. All right, so to set this trade up so that you can understand the back testing and the results of the back test, let's first just kind of lay some groundwork on what the trade originally was before our current market environment. All right, so just nice and easy. I'm going to just knock all this stuff off of there, and we'll go out to a 1 year daily chart. All right, now on this 1 year daily chart, we want to add an indicator that was made by Mobius. It's called the weekly expected move. Now, this weekly expected move that Mobius made was based on the concept really popularized by Don Kaufman at TheoTrades, and that is that every week the firms or the institutions out there are picking one of these lines and they are selling a bunch of strangles or straddles at that location. And that during the week, if we happen to break out of that expected move, most of the time we will come back in and we'll actually close the week inside of that box. And that when we don't do that and we actually continue to drive farther out of the box, that if we extend too far in one direction, the algos will actually fire up and they will buy into buying or sell into selling to get back to delta neutral. And what they're buying and selling are the ES futures, because the ES futures have a hard delta. This logic that was proposed by Kaufman, it's not an original logic, right? It's not like he just came up with that all on his own. It's a collection of logic that exists in the world today. And if you was to dig deeper into negative gamma hedging and concepts like that, when the market making firms trade with you, they're obligated to take the other side of your trade. So for an example, if you want to buy a call, they'll sell it to you, but now they're short a call. They're short deltas. They need to get that back to zero. And they'll go out and do trading as well to maintain that delta neutral or delta zero position status, right? So there's a lot of different reasons why the market does this particular thing. But circling back, Mobius had listened to Don on this, and Don hand draws these lines every single week. But you can imagine if you're wanting to do it in other markets besides the S&P, then you're having to go and draw all these lines in advance, because these lines are static. They are set into place on Friday for the new week. So for an example, there's no lines right here, right? Because we're not into a new week. But tomorrow on Friday, when we open that day, there will be a new set of lines here. And those new lines will move with the market up and down through the day. And at the close, at the end of the day on Friday, they will lock into place and they will no longer move. So that's what this indicator is doing. These lines are based on the weekly expected move. So we come over here and we look at these lines. We want to look at Friday, June 10, it's tomorrow. There is the expected move, but this is a dynamic expected move. It is constantly moving. It's constantly changing. We want it to lock in place from one Friday to the next. We want to recognize what was the range going into the close on Friday for the next week. What was our expected move for the week, which is why we call this the weekly expected move. If you don't have that on this broker, Thinkorswim, you can go to the Analyze tab and you can go back to last week. So we go to Analyze tab, we go to the Think Back, we can choose the date that we want to go back. So suppose we go to June 3rd. This will show us where was the market going into the close on June 3rd, and what was the expected move for the week, and that would have been June 10. The expected move for the week was $101.11. So we would add that to the current price to get our top side expected move. And we would subtract that from the current price to get our downside expected move. And we would hand draw those lines on the chart. Well, the indicator is doing that for us, but it's not as accurate as hand drawing it. And one of the reasons for that is because we don't have access to this information using Thinkorswim ThinkScript. So we have to get this same number other ways. Now, that becomes a little tricky. It's a proprietary number. Almost all options brokers have some form of expected move, but how they get that number has a little bit of their own secret sauce in it. So some of it is public. Some of it we know. It's got the square root of time built in there. And if we're talking about the implied volatility side, that right there, that implied volatility average, we also know that it's using all of the out of the money options on the call and put side, and it's tallying that up. But there's still a little more that we don't know. So we can't mimic that number perfectly. So Mobius's indicator won't perfectly accurately describe that expected move, but it's close enough. It's close enough. So we're looking at the SPX here. If we turn on the hand drawn lines from Dawn, we can see that they're just slightly off. And that when we are in a high volatility environment, they're more off than when we are in a low volatility environment, right? So it doesn't have to be perfect, but that is the gist of everything that we're focused on. We want to put on trades that anticipates price staying inside of this box by the end of the week. Now there's other trades that we can put on. The SPX actually closes on one of these lines more than it statistically should. That is a huge benefit on our side. But we're going to set that one aside for now because that's more of a butterfly talk, and this is an Iron Condor talk. We want to place trades that says, I bet you stay in the box. Now, there's a lot that goes into this. So history behind it, when it starts to break out repeatedly, closing outside of the box multiple days in a row or multiple weeks in a row. And then there's times in history where it was just dead on perfect week after week after week. So there's a lot to that. And then there are other metrics, like have we even touched the side of the expected move this week? Did we touch it last week? And that's kind of the situation we're in right now, right? We didn't touch the edge last week on either side, and we didn't touch the edge this week on either side. So it is very, very likely if we end the week without having touched either edge, that we will very, very likely hit the edge next week. So one of my metrics is if we've had 2 weeks in a row where we have not hit the edges of the expected move, I will not put an Iron Condor on that next week. I will not do that. Okay. Another one is if it's just one breach where we close outside the week, that doesn't concern me too bad. But when we start to get repeated breaks and closes outside of the week again and again, that is a huge heads up. The greatest thing about this indicator is that you can go back in the past and you can look at what we have done before. Say right before the COVID crash, for an example, in February, we started to get a lot of misses through December and January that were implying things were getting really violent and it wasn't showing up in all of the normal metrics, right? The expected move was still small, and yet price was expanding beyond that expected move and closing outside of it more and more at the end of the week, right before the crash. So there's that metric. I like to use round numbers. It makes things easy to make generalized statements like what I'm about to say. So if we want to know, hey, what's the accuracy right now? I could count back 10 weeks. How many times in the last 10 weeks have we ended the week outside of the box? And if I count, say, 2 out of those 8 weeks, then we could say it's been staying in the box 80% of the time. Obviously, you could count back 10 weeks, 100 weeks, 1,000 weeks, and you can get your number however you want to get it. I use 10 weeks. I just count back 10. If we use a little bit of the drawing tools, Don actually highlights with his drawing tool when the market closed outside of the expected move. Now, because of the color of my chart, his drawings are a little hard to see. But one of them is here. And one of them was here. And one of them is here. So that's for the year, because here's the year line. And those are times where we've closed significantly outside of the box for the week, right? Or let's look again. Maybe those are times where we left the range for the day, right? So let's go for the week and we'll just count back 10. So we know last week we stayed inside and the week before we did not. We broke out the week before. We ended the week outside. We were in that one. We were in that one right there. This one looks like by a hair. We were outside of it. And we may have finished just barely by the end of the day coming back in on this day, but I'm going to go ahead and mark it. All right, so we're running at around a 710 right now. So 70% of the time we've been closing inside of that. Now, since it's a 1 standard deviation move, 68 point blah, 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 we say 70% is what it's supposed to be. But see, with the SPX, it actually beats its expected move standard deviation more than is statistically accurate, right? So it says it should be in there 70% of the time, but historically it's been in there closer to 80% of the time. There's so many edges that we get by trading in this product. So now that I've gone through all of this background, what's the trade? Well, the trade was, before we got into the current market conditions, the trade was that we would build Iron Condors in the expectation that price would close inside the week or inside of our Iron Condors more often than it wouldn't, and that we would make money from that. For a few years, that worked out really good. But here's the rub. Here's the problem. I'm going to go back before COVID, and we're going to look at one of these weeks, and I'm going to copy the size of the box. So we'll just use our drawing tool here. We'll draw a box, and I'm just randomly picking a week. It wouldn't matter. That was the size of the weekly expected move. I happened to pick a week where it was a 4-day week. So let's just move it over a little bit and go to a different week, because that was a holiday week. That was right around the New Year's. And we'll use this one. Okay, so that was the size of the box for the week. And it's actually a 5-day week, even though the 5th day was way up there. But what we want to know is the high and the low of that week. Okay, so I've got it. I'm going to copy it, set it to the side here. And now we're going to zoom out. We're going to zoom out and we're going to take that box with us into the current market that we're in. And this is why I haven't been running my weekly Iron Condors. See, back in the day before COVID, if we built our Iron Condors using those lines to select our strikes, we would get a trade with some reasonable credit in it, a reasonable amount of risk, and a high risk reward, or a high win rate. It's almost the unicorn trade, right? Low risk, reasonable reward, high pop trade. You couldn't ask for anything better. But when the size of the box started to expand, and you look at the size of the box that we have right now, compared to the size of the box we had then, you can imagine why that trade is no longer viable. If we built the edges of our expected move that far away from the current money, then we're building a trade that very often is risking $450, $475 for $25. I mean, it's just a negligible, tiny amount of money. And while you would still win, say 85 or 90% of the time, when you did lose, they were horrible, horrible losses that would completely wipe out all of those wins. Especially, and here's the worst part, especially because most of us close a trade down early. We are taught to close them down at 50% profit or 45 or 60%. And yet on the losing side of these trades, you really don't know if you should close it down when it's losing, because the S&P recovers back inside of the box a lot. So we may go outside the box on Tuesday or Wednesday, but by Friday, we're back in the box again. And if you close it down early, you're just taking a loss that you didn't have to take. So you almost have to throw them on, set them and forget them on the loss side. They'll either work and they won't. But if you do that and you assume max loss on the losers, you have to assume max loss on the profit. You have to. If you don't, then you need something like option omega. Okay, so that is the backdrop of this trade. Normally what we would do is Friday afternoon before the end of the day, but near the end of the day, we would start working the order for the Iron Condor, and we would build it along these lines. Now, options omega doesn't have expected move like this. And so I can't program it to show me back tested results based on this expected move. But I started going back and calculating where was the put side delta of the expected move for just this year. And if you're asking, why am I doing the put side? Well, we're in a bear market, or we're in a negative market. We're in a market that is not advancing. So if we were going to challenge the call side frequently, I would have measured the call side. But we're challenging the downside more than the upside. So I'm using the put side of this. The great thing about backtesting is when I have more time, I'll be able to do both sides, get the numbers, get more statistics, dial this in and hone this in more. But for right now, just work with what we got. When I went back and I looked at just this here, and you can see I don't have very many dates, say 5 of them. We're running around the mid 20s on our put delta side. And I wanted the trade built equidistant. So if I'm hitting 20 to 25 on the put side, I'm going to do the same thing on the call side. That, when it comes to equidistant, we have to kind of explain that. I want each side to be $5 wide. So that is equidistant on width. But I'm talking about location placement. With location placement, we want to center our trade in what is referred to as a delta neutral position. So let's just open up the trade tab and kind of knock these numbers down to a reasonable value. And I'm going to put on $5 wide put spread here. I'm not going to actually place the trade. We're just going to stick it over into the Analyze tab. All right, so we put it into the Analyze tab. I got to hide the trade that I'm currently in. And there you go. No, there's still something down there. What else you got? Oh, okay, we've got a vertical on there. Okay, so there's an Iron Condor. Now, if you notice this Iron Condor, while it's not perfect, it's pretty close. What we're trying to do in a delta neutral situation is center that Iron Condor. We want to open it while price is pretty close to the middle of the trade. And that way, you know, it's about equidistant to each side. If we don't do that and we start skewed on one side, then we were actually building a more of a directional Iron Condor, which is fine. I'm not saying that it's good or bad or right or wrong, but if our goal was to mimic the expected move for the week, and we're using the put side measured delta equivalent, then we want the call side to be the same, right? So for an example, if I came in and I made this 4,100 and say 4,105, Now you can see where price is very close to the top, and it is a long ways away from the bottom. That would be considered not a delta neutral position. And of course, as soon as you open it, you would lose any of your delta positioning anyways, because price would move left and right, and we don't go back in and rebalance and recenter, but it's more of a discussion of where are we going to start. And although we're using the 25 delta on the put side, there is an argument to be made for, should you also do it on the call side? Or should you count how far out you went on the put side and go equally distant to far out on the call side? So counting strikes, if we look at where the 25 delta is, that would put us at 40.50 and 40.45. Well, how far away from price am I? Price right now is at 40.95 at 4,100, right around in there. So we're talking about 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 strikes out of the money. Okay. So if I didn't want to use delta on both sides, and I started with delta on the put side at 25, what would I use for the call side? Would I count down just like I did a moment ago and choose those strikes based on my count? Or would I choose my strikes based on those delta values? And, most of the time we don't actually get the delta value we want. I see a 25 here, but 25 is what I want. So maybe it would have been better to see a 26.24, right? And that way I could choose a 26 and a 24, and I would know that 25 was in the middle somewhere, right? So it's never a perfect science. One thing, though, that I will point out is look at the amount of credit we received. Now, this is crucial in the options world. That credit is a reflection of my POP, my probability of profit. This Iron Condor is $5 wide. And if I want a 50% POP trade, then I want to try to build the width of the spread at half the credit, at half the width, right? So if I could get that order worked for 260, that would even be better, right? I'd be receiving better than 50% of the width of the spread. So there's a lot of inherent factors. So we don't have all of those things on the Omega tool yet, but I say yet because it seems like every single week they are improving this thing through feedback and through insight from other traders. So who knows what will be there next? So I have now teed up all of the background. Okay. Let me show you year to date back test, meaning I started January 3rd, which is the first trading day of this year, all the way up to today's date. What kind of results were we getting? Now, in the pictures that we're looking at here, I actually had a stop loss in place. And the trade was being opened at 9:45 with that stop loss. So let's call timeout for a moment. I had already discussed that we were doing end of day trades, so we would put these on later in the afternoon. Well, when I was back testing, if we built the trade later in the afternoon, it actually lost more often. That was odd to me at first. It was confusing. I didn't understand why that logic was true. Why is it losing more? And it actually comes down to the decay that we get. Remember, these are not just price-based moved trades, right? They're Iron Condors. They're static positions. We don't want price to move. They also generate returns based on decay. So if we put them on Friday morning, they have all of Friday to decay. And then they go into the close on the weekend and there's more decay. And then on the new week, we're already having decayed significantly and we're a lot closer to our close goal. My concern was putting them on in the later part of the day would give us more accurate expected move lines. And that is absolutely true. But remember, we can't back test using those lines. We're actually back testing using a 25 delta on the put side, because that was the statistical placement for year-to-date expected move lines. So putting them on intraday intuitively makes more sense, because we think we can be more accurate with that line placement. In reality, because of the way options price, we're better off putting them on in the morning. So that is insight. The next thing is that stop loss. Remember, I mentioned that the S&P has a particular habit of actually leaving the range, but coming back in and closing the week inside the box. So if you set a stop loss on a credit spread, you will very likely trigger that stop loss. And make no mistake about it, these are credit trades. It may be an Iron Condor, but that just means it's two of them. It's still a credit trade. So I ended up later on actually removing that stop loss. These are all loss or not measured trades. Okay. Now, obviously, in the real world, you could determine for yourself if the trade has any viable hope of winning or not, and closing it down with some form of salvage on the losing side, which is great, but we don't want to try to price that in, right? We want to just say, if it loses, we're going to lose all of our trade, because, you know, as far as I'm concerned, when I'm trying to figure out what kind of money I have at risk, I don't want to pretend that I may hopefully kind of sort of salvage a loser. I would rather man up to it and say, this trade is gone. There's nothing I can do about it. And in fact, it's down so much at this point, there's no reason to close it, because I have a better chance of it rallying back and getting some money out of it than I do just closing it down and sucking it up and taking my loss days early. So we're going to go for either a win or a loss. There's no stop loss side of that. Okay. The profit target in the picture here is 38% with that 90% stop loss. Like I said, these pictures were my first attempt, and that was kind of fine. There's not a big deal. There were actually 20 trades for this year. Remember, we're going from January until June 7 when I took these pictures. 20 trades, 16 winners, average time in trade about 3.5 days. But here's the deal, and the number kind of surprised me at first. The max winner was almost as high as the max loser. Later on, it actually is higher. Even though I removed the stop loss, the maximum winning trade exceeded the maximum losing trade. That's right. So shocking numbers. And then the average winner, 28, versus the average loser, 49. Now, here's where the things start to trade a little bit. I was looking at that loss rate, and I wanted to know if I adjusted the probability, or excuse me, if I adjusted the target profit, when would I step up on my loss rate? If 16 winners and 4 losers is as good as I can get, which gives me an 80% win rate, could I get a higher profit target and still not change the win versus loss rate? Remember, I'm going to win 16 times. How much of that win can I actually get? 40%, 41%, 42, 43, 44, 45. If I aimed for 46% profit target, I actually adjusted the win-lose rate at that point. We aimed too high. So if I aim for 46% profit target, we actually added another losing trade, and it knocked the win rate, or the winning value, down, our profit on the year, because we added another loser, and losers are max loss, right? We're not making any adjustment for the losing side. And it also changed our win rate to a 75% win rate. So if I wanted to keep my 80% win rate in this back test scenario, I could not exceed 45% profit target, which is fine because it really is kind of close to that 50% window that we talk about a lot, right? And it's the one that Tasty Trades and Options Alpha and a lot of those other places talk about. The odd thing is TD Ameritrade has all of their webinar series and presentations, and Barbara Armstrong over there, she likes to go for an 80% win rate. If she was running this strategy, that 80% win rate would just destroy everything. That doesn't mean she's wrong, because the Iron Condor strategy and the verticals that she talks about is not based on these expected move values. I was only mentioning her because she has that 80% target profit, and that is her go-to. It's her default that she aims for 80%. So there is no magic number out there, but 45 to 55 is about the norm, and that number was not a surprise to me. Okay, so we're going to stick with that 45%, and you'll actually see later on through other things that we keep that same number. So I tried going into the 50s. I tried to increase the target profit a lot. No help. Everything just kept getting worse and worse and worse. The best money made was 128. Well, it was the ending portfolio value, 28,000 with a starting portfolio of 100,000. So that was as best as I could get from January to June with an 80% win rate and losses that I could actually stomach. That's where we were at. If I tried to get it to a higher number, the losses increased significantly, losing trades and just not as much money, right? Because there's always the argument of, well, if I aim for higher profits, when I do lose, I will have money to pay for that losing trade. This shows that for this strategy, forget about it. It's just not any other way to come around it. All right. Now, all of this has been year-to-date values, but what if we actually did run a 12-month back test? And I'm going to point out that for this one, we're still not, this is just year-to-date yet, but I've adjusted some of those things that we had talked about. So we're looking at getting in at 9:45 in the morning. We're doing it every Friday. We're going to use 5% of that $100,000 portfolio. And this has a 90% win rate. And the maximum funds was 47, because remember, we started with 100,000. We made 47,000 between January and June 6. 19 winners, 1 loser, 95% win rate if we jumped down to 29%. Remember, this back test in all these pictures right here, this was running at 45%. So with a 45% profit target, we could net 147, but that 90% win rate, meaning we would win 9 out of 10 trades, is pretty good, right? In this case, it was winning 18 out of 20 trades. So there was 2 losing trades, 90% win rate. Well, we can bump that up a little more, and we could actually win 19 out of 20 trades. But 19 out of 20 trades netted 44,300, whereas the other strategy netted 47,900. So almost 48,000. That's an additional, it's close to an additional $4,000. The reason I added this one down here, though, is because losses are hard to deal with. I don't care who you are, losses suck, right? They just suck. So if I tell you, hey, I got a strategy, but you're going to lose twice, or hey, I've got a strategy and you're only going to lose once, one's going to make you more money than the other. Statistically speaking, which one would you want to do? Now, that is completely up to the person, right? Maybe a lot of people would say, I want more money, so I'll take the 2 losers. Okay. And then there's other people who will go through fire and brimstone to avoid a loser no matter what. And maybe they would choose to take a little less profit, but to also have less losses. I'm not here to debate it, right? So now let's look at the 12-month. So now instead of going just from January to our current time frame, let's step out a little bit more, and maybe we're going to go backwards this time. This had 48 trades total. 42 of them were winners with an average time in trade of less than 5 days. This doubled the account. Remember, it's a $100,000 account, more than doubled the account. And when we scroll up, what did I adjust in here? Well, the only thing that I adjusted is how long we were going to do our look back. That was all that I adjusted. All right. So it's still using 5% of the portfolio. We are still targeting 45% profit, and we're getting in the later part of the day on Friday. Or excuse me, we're getting out. If we haven't hit our target profit, we're getting out by the later part of the day on Friday. We're still getting in the mornings. Now, what's the basis for this trade? This thing is not looking at VIX. It's not looking at stock price. It doesn't care where the market went this week. Are we up? Are we down? Is it a positive week? Is it FOMC week? It's not looking at anything more than, oh my gosh, it's Friday at 9:45. I got to go get my Iron Condor on. That's it. Now, granted, when we look at the number of trades that it actually used, when we allocate 5% of $100,000, it was a 5-lot and a 6-lot oftentimes. Now, that's important information that I haven't yet put in here, because I'm really trying to keep this video short. I know it may seem like I'm just running on, but guys, with multiple lots like that, with a 5-lot, 6-lot, 7-lot, we could be fading out of these, say closing some at that 29%, closing some at the 45%, and hell, leaving one on maybe for a Hail Mary pass, seeing if we can get to 90% or 100%. Right? So some of these could have been blowout winners. And remember, on the loss side, I ran them that a loser was 100% loss. I didn't even want to pretend that I could salvage a loser, because I've been trading options for a long time now. And I can tell you that a lot of times there is just no fixing that loser. Longer duration losing trades, there's a lot of things that we can do, right? We can add legs, we can adjust the legs, we can roll. There's a lot of things. But when you're in a very short duration trade like this, a lot of times there's just nothing that you can do. And I don't want to try to pretend or use any kind of cheated back test and try to fool myself into believing that I could actually stop something from taking a max loss. So I'm going to keep that max loss position in all of my back testing from here on out when it comes to any sell side option trade like this, because we are selling to open these. So guys, that's my back test. If you haven't heard of this company, they're supposed to be doing a webinar with the bullish bears. We got a loose time frame of June 20th, not dead set on that yet. There could be an adjustment, but they're going to come in, give you a presentation, kind of go over the numbers. Notice that I didn't show their platform. I took some pictures, but I didn't bring it up. And that's because I really didn't want to get into the settings, get to messing around with stuff. I wanted them to present it, right? They know this thing way better than I do. I just took some pictures that went with this because I'm going to be putting on the Iron Condor again, guys. And for anybody who's known me for a while now, it's been a long time since we've had our automatic trades back. And this is one of those automatic trades. We'll be bringing the others back online once I finish back testing the verticals and the double calendars. It's on, guys. We're back. So that's it. Give me some feedback on this, your input, and I look forward to seeing you at that webinar on the 20th.